Eligibility for SBA small business loans. Securing financing is a critical milestone for any entrepreneur, but navigating the maze of eligibility requirements for U.S. small business loans, particularly those backed by the Small Business Administration, SBA, requires a strategic approach. At its core, eligibility for most federal and traditional small business loans begins with the legal definition of your entity. To qualify for SBA assistance, a business must operate for profit, be physically located and active within the United States, and meet the specific size standards dictated by its industry's North American Industry Classification System code. Generally, this means having fewer than 500 employees or staying below a specific annual revenue threshold, such as $7.5 million from many service industries. Furthermore, the business must demonstrate that it has exhausted other financing options, a requirement known as the Credit Elsewhere test. Ensuring your business is properly registered and meets these foundational criteria is the first non-negotiable step toward a successful application. Lenders and the SBA place heavy emphasis on the character of the borrower, which is primarily quantified through credit scores. While specific minimums vary by lender, a personal credit score of 680 or higher is often the benchmark for the most favorable terms in programs like the SBA 7A. For smaller loans, the SBA may use the FICO Small Business Scoring Service, which aggregates personal credit, business credit, and financial data into a single score. Maximizing your approval odds involves cleaning up your credit long before applying. This includes disputing inaccuracies on your credit report, lowering your credit utilization ratio to under 30%, and ensuring a flawless history of on-time payments to both personal and business creditors. A business's ability to repay a loan is mathematically scrutinized through the debt service coverage ratio. Lenders typically look for a debt service coverage ratio of 1.15 or higher, meaning the business generates 15% more cash flow than is required to cover its total debt obligations. To maximize your chances, you should focus on stabilizing your cash flow by streamlining invoicing, managing inventory more efficiently, and cutting unnecessary overhead expenses to boost net income. Proving that your business is not just surviving but thriving provides the empirical evidence lenders need to justify the risk. Consistent, positive cash flow is often more persuasive to a loan officer than high revenue alone. Beyond operational health, most significant small business loans require an equity injection, your own skin in the game. For startups or business acquisitions, a down payment of at least 10 to 20% is standard, though this can climb to 30% for higher-risk ventures. This investment signals to the lender that you are personally committed to the success of the project. If you lack liquid cash, you might consider bringing on a partner or utilizing personal assets to meet this requirement. Showing that you have already invested significant time and personal capital into the enterprise builds a narrative of commitment that complements your financial data. Collateral acts as a secondary source of repayment and is a major factor in securing larger loan amounts. While the SBA will not necessarily reject a loan solely for lack of collateral, lenders are required to follow certain collateralization policies, often requiring a lien on business assets like real estate, equipment, or inventory. In many cases, if business assets do not fully secure the loan, the lender may request a lien on personal real estate. To maximize approval, you should prepare a detailed collateral schedule that accurately values your assets. Offering strong collateral can sometimes offset weaknesses in other areas of your application, such as a shorter time in business. The backbone of any successful loan package is a comprehensive, data-driven business plan. This document must go beyond a simple summary. It should include a clear use of proceeds section, detailed market analysis, and 3 to 5 years of financial projections. Lenders want to see exactly how the borrowed funds will generate the revenue necessary for repayment, whether through purchasing new equipment to increase capacity or expanding into a new market. A plan that acknowledges potential risks and outlines mitigation strategies demonstrates a level of professional maturity that inspires confidence. An organized, professional presentation suggests that the borrower will be equally disciplined in managing the loan funds. Organizational readiness can significantly speed up the approval process and prevent death by 1,000 questions. You should have at least 2 to 3 years of both personal and business tax returns, current year-to-date profit and loss statements, and a detailed list of all existing business debts ready for review. Discrepancies between your internal books and your tax filings are a major red flag for underwriters. Taking the time to work with a CPA to ensure your financial records are loan-ready is one of the most effective ways to maximize your approval chances. Clear, transparent, and professionally prepared documentation minimizes friction and builds trust between you and the loan officer. Finally, the choice of lender can be as important as the application itself. While large national banks offer competitive rates, community banks and credit unions often have a deeper understanding of the local economy and may be more flexible in their underwriting. Building a relationship with a local lender early on by opening business accounts or seeking smaller lines of credit can create a track record of reliability. If you were turned down by one institution, don't be discouraged. Different lenders have different appetites for risk and specific industries. Asking for feedback on a rejection allows you to refine your approach and address specific concerns before applying to the next potential partner. We welcome you to subscribe to our YouTube channel for more informative videos on business and finances. Thank you.